Hi everyone, welcome to this session of Tiger Academy, 5 common types of orders used in US stock trading. In the previous lesson, we learned the 2 types of trading accounts for US stocks, the cash account and the margin account. So in practice, how do we place, buy, and sell orders? That brings us to the topic of today's lesson, buy orders and sell orders. There are different ways of creating and submitting orders for US stocks, so that different types of orders can be used in different trading scenarios. For example, you can entrust a broker to place an order by telephone, or you can trade online and place an order through your broker's app. There are even traders who still physically call out orders on the floor of the exchange. In this lesson, we'll focus on how to place orders on the Tiger Trade app. Before you start placing orders, you should be aware that there are 5 main types of stock orders: limit orders, market orders, stop loss orders, stop limit orders, and trailing stock orders. Number 1, limit orders. A limit order is an order to buy or sell a stock at a specific price. A limit order is the most common and most widely used method of placing an order in stock trading. Enter any stock code into Tiger Trade app, access the trading screen, and then you can select the order type. To place a limit order, select Limit Order, enter your desired execution price, enter the quantity, then click Buy or Sell. It's just that simple. Your order will be executed at the limit price you set or better. The biggest feature of using limit orders is that you can trade with a specific price in mind. So limit order trading means price first and speed of execution second. Let me give you an example to help you understand better. Let's say you want to buy Apple stock using a limit order. The stock price is currently at $170. So if you enter $168 as your execution price, the trade will not be filled right away. The order will only be filled if the market price falls to $168. Similarly, if you want to sell Apple stock using a limit order and the current stock price is $170, if you enter $172, the order will not be executed until the market price rises to $172. From this example, you can see the advantage of using a limit order is that investors can place orders with the best price in mind, thereby controlling the cost of buying and taking profits from selling. However, if the limit price that is placed to buy a stock is too low, or the limit price that is placed to sell a stock is too high, the order may not be filled and timing will be lost, which can be costly to an investor. Number 2, market orders. If limit orders are price first and speed of execution second, then a market order is speed of execution first and price second. In stock trading, because prices are sometimes changing too quickly and the number of people queuing for transactions is too large, you'll need to repeatedly change your limit order price, which will delay the execution of your order. In this case, you can consider using a market order. After selecting the market order, you can find that you can place the trade without entering a price, just the quantity. But keep in mind that if you have a price of $50 in mind for buying a stock that is moving rapidly, a market order is likely to be filled at a higher or lower price. Therefore, in a fast-moving market, the price at which a market order will be executed often deviates from the real-time quotation. So, market orders will be quickly executed, but there is no guarantee that you'll get a good price. As a reminder, limit orders can be placed during pre-market and after-market hours, but market orders can only be placed during normal intraday trading hours because pre-market and after-market trading volume is usually very light, and the spread between buying and selling price of shares is extremely wide. It's not usually cost-effective to trade with market orders because you cannot set the price. Not being able to place market orders outside of normal trading hours is intended to protect investors in the US stock markets. Limit orders and market orders are the most basic and common methods to place orders. And when these 2 are combined, additional types of orders can be created. Number 3, stop loss orders. The first of these types of orders is the stop loss order. A stop-loss order is a combination of a limit order and a market order to buy or sell when a stock reaches a specified price. When the specified limit price is reached, it is executed as a market order. For example, if the price of a stock fluctuates greatly and the current market price is $100, you can place a stop-loss order at $95 to prevent excessive losses. If the stock price falls to $95, the order will automatically be triggered to sell at the market in order to prevent further losses. Many investors will ask, can't this also be achieved by setting a limit order to sell? It's possible, but if a stock doesn't have a lot of trading volume at $95, there's no guarantee that your limit order will be filled. If, however, you place a stop loss order which becomes a market order at $95, the trade will certainly be executed, but not necessarily at $95. I have to remind you that stop loss orders are not only used to control losses. If you're afraid that the stock price will suddenly soar and miss an unexpected price, you can use a stop loss order to buy a stock too. Number 4, stop limit orders. Since a stop loss order may not be filled at the price you have in mind, is there a better way? Let's talk about stop limit orders. When you place a stop limit order on the Tiger Trade app, you will see 2 prices, a stop price and a limit price. The stop price is the equivalent of an alarm signal. When the stock price falls to the stop price, it will immediately trigger a sale that will be executed at no lower than the set limit price. Using this type of order guarantees that the stop price is reached. There is a high probability that the trade will be executed between the stop price and your limit price. Why do I say high probability? Because if you set your limit price too close to your stop price, say $138.05 stop with $138.04 limit, when stock prices are fluctuating wildly and sharply, the price may quickly fall below your limit price and there will be no takers for your sell order in the market. This can result in your order not being executed. To sum up, if the difference between the stop price and the limit price is too small, the order may not be filled. If the difference is too large, it will increase your losses when the market fluctuates sharply. So you need to be careful when setting the gap between your stop and limit prices to ensure that the trade will be successful. Not too small and not too big. As I've said, a stop loss order is a limit price plus a market price, and a stop limit order is basically a stop price plus a limit price. Market orders cannot be executed before or after market hours, so stop loss orders can only be traded during intraday trading hours. Stop limit orders, however, can be traded at all hours. Number 5, trailing stop order. Now that we've covered 4 of these order types, let's take a look at the 5th and last type, the trailing stop order. A trailing stop order is like a stop loss order plus. It's a way of placing an order to control losses that tracks the trading trend. If you choose to enter a trailing stop order in the Tiger Trade app, you will find that there is no price here, but you have the choice to set the price according to a spread or percentage ratio. What does that mean? For example, let's say you're bullish on Apple and you place a trailing stop order to buy at a market price of $150 with a spread of $2. Let's say after the order is filled, the stock prices rise sharply to $170 and then begins to pull back. Because of the $2 spread that you factored in, when the stock price pulls back to $168, the system will automatically trigger a sell order, helping you preserve most of the fruits of your victory. That's how a trailing stop order works. Of course, in addition to being able to set a spread, you can also choose a ratio. Assuming you pick 1%, a sell order will be triggered when Apple retreats from $170 to $168.30. Therefore, the trailing stop order is a better way to place an order that helps protect the profits that you have already made. Number 6, order status. Now that we've covered the 5 most common types of orders for US stocks, I'm going to take you back to the Tiger Trade app trading screen and show you how to check the statuses of your orders. First of all, in the Tiger Trade app trading screen, you'll see that there are 2 validity periods. One is day and the other is GTC. Selecting day means that the order will be automatically canceled at the end of the trading day if the order was not filled by that time. GTC means good till canceled, and it is a perpetual order that will remain active until you physically cancel it. We need to pay attention to the risk of good till canceled orders due to the unpredictability caused by the sometimes wild stock price volatility that can occur in the US stock markets. It is recommended that you exercise caution when choosing to use this type of order. Finally, let's take a look at the order status. After you successfully place an order, click on Portfolio in your stock trading screen and you'll see the details of positions already held in your account, including the market value of the positions, the quantity of each position, the current price, the cost of price, and the floating profit and loss. For long positions, quantities will be displayed as a positive value, and for short positions, they will be displayed as a negative value. In addition, if you click on Open Orders, you will see orders that have been placed but not yet filled. At this time, you can modify your order price and quantity, and you can also click Cancel to remove the order from the queue. Alright, that's all for today's lesson. Have you learned the 5 most common ways to place an order? Now let's review what we've covered today. Limit orders, market orders, stop loss orders, stop limit orders, trailing stop orders, order status. After learning these points, I think you've now got the idea of these 5 common types of orders, and you can choose the most suitable order method according to specific trading scenarios that best suit your trading needs. In the next lesson, I'm going to introduce you to more stock trading functions on the Tiger Trade app so that you can trade stocks more conveniently and accurately. I'll see you next time.